Welcome to our video on 20 tips on how to make money investing. Please remember to like and subscribe for more tips on how to make money. Make sure to stay until the end to hear an exciting bonus fact. In this video, we'll be covering a variety of strategies and approaches you can use to invest your money and grow your wealth over time. Whether you're a beginner or a seasoned investor, there's something here for everyone. So let's get started. Tip number 1, start early. One of the most important things you can do to maximize your earning potential through investing is to start as early as possible. The earlier you start saving and investing, the more time your money has to compound and grow. The power of compound interest can have a significant impact on your wealth over time. Compound interest is the interest you earn on your principal plus any interest that has been accumulated over time. It's a powerful force that can help your investments grow exponentially over time. By starting to invest early and reinvesting your returns, you can take advantage of compound interest and potentially build a significant amount of wealth over the long term. In addition to taking advantage of compound interest, starting to invest early also gives you more time to weather market ups and downs and potentially make up for any short-term losses. It's important to remember that investing is a long-term process and it's normal for the value of your investments to fluctuate over time. By starting early and having a long-term perspective, you can potentially ride out any market setbacks and still come out ahead in the end. Tip number 2, invest for the long term. Another important tip is to think about the long term when investing. While it can be tempting to try to time the market or chase short-term gains, it's often more effective to take a long-term perspective and focus on building a diverse portfolio of assets that can weather market ups and downs. Tip number 3, diversify your portfolio. Diversification is a key principle of investing that involves spreading your investments across a range of different asset classes, sectors, and geographies. The idea is to reduce risk by not putting all your eggs in one basket. For example, rather than investing all your money in a single stock or sector, you could invest in a mix of stocks, bonds, and other assets, and spread your investments across different industries and countries. There are many ways to diversify your portfolio, and the specific mix of investments that's right for you will depend on your individual goals, risk tolerance, and other factors. Some common strategies include investing in a mix of stocks and bonds, investing in mutual funds or exchange-traded funds (ETFs) that hold a diverse range of assets, and using asset allocation strategies to help balance risk and reward. By diversifying your portfolio, you can potentially reduce the overall risk of your investments and increase the chances of finding successful investments. However, it's important to remember that diversification does not guarantee a profit or protect against loss, and it's always possible to lose money when investing. Tip number 4, understand your risk tolerance. Before you start investing, it's important to understand your own risk tolerance. Some people are comfortable taking on a lot of risk in pursuit of higher returns, while others prefer a more conservative approach. Understanding your own risk tolerance can help you make investment decisions that align with your goals and values. Tip number 5, research your investments. It's never a good idea to blindly throw your money into an investment without doing your due diligence first. Take the time to research the company or fund you're considering, and try to get a sense of its financial health and potential for growth. Tip number 6, consider professional advice. If you're new to investing or just not sure where to start, it can be helpful to seek out the advice of a financial advisor or professional. A good advisor can help you understand your options and develop a personalized investment plan that's tailored to your needs and goals. Tip number 7, use tax-advantaged accounts. One way to make your investing more tax-efficient is to use tax-advantaged accounts like 401ks, IRAs, and HSAs. These types of accounts can help you save on taxes in the short term and potentially earn tax-free returns in the long term. Tip number 8, regularly review and rebalance your portfolio. Your investment needs and goals are likely to change over time, so it's important to regularly review and rebalance your portfolio to make sure it still aligns with your current situation. This can help you stay on track and make sure you're not taking on more risk than you're comfortable with. Tip number 9, use dollar cost averaging. Dollar cost averaging is a strategy that involves investing a fixed amount of money at regular intervals, regardless of the price of the investment. This can help to smooth out the ups and downs of the market and reduce the risk of making a poor investment decision due to short-term market fluctuations. Tip number 10, invest in what you know. It's often easier to make informed investment decisions when you have a good understanding of the industry or sector you're investing in. So, consider investing in companies or industries that you have some knowledge or expertise in. Tip number 11, avoid the temptation to try to time the market. One of the biggest mistakes investors can make is trying to predict short-term market movements and attempting to buy or sell accordingly. This strategy is often unsuccessful and can result in missed opportunities or unnecessary losses. Instead, focus on building a diversified portfolio and sticking to a long-term investment plan. Tip number 12, don't put all your eggs in one basket. In addition to diversifying your portfolio, it's also important to diversify within individual investments. For example, if you're investing in a mutual fund, make sure it holds a wide range of different stocks rather than just a few. This can help to reduce risk and increase the chances of finding successful investments. Tip number 13, invest in low-cost index funds. Index funds are a type of investment vehicle that track a particular market index, such as the S&P 500 or the Nasdaq. They are considered a passive investment because they simply track the performance of the underlying index, rather than trying to beat it through active management. One advantage of index funds is that they tend to have lower expense ratios compared to actively managed funds, which means you'll keep more of your returns. Additionally, index funds can offer diversification benefits because they hold a large number of stocks, often in the hundreds or even thousands. This can help to reduce risk and provide exposure to a broad range of companies and sectors. There are many different index funds to choose from, ranging from those that track broad market indexes to those that focus on specific sectors or regions. It's important to carefully consider your investment goals and risk tolerance when selecting index funds to add to your portfolio. Tip number 14, consider alternative investments. In addition to traditional stocks and bonds, there are many other types of investments you can consider, such as real estate, commodities, and even alternative assets like art or collectibles. These types of investments can add diversity to your portfolio and potentially provide higher returns, but they also come with greater risk. Tip number 15, take advantage of compound interest. Compound interest is the interest you earn on your principal plus any interest that has been accumulated over time. It's a powerful force that can help your investments grow exponentially over time, so it's important to take advantage of it by starting to invest as early as possible and reinvesting your returns. Tip number 16, use your excess cash. If you have cash sitting in a savings account or other low-yield investment, it may be worth considering using it to invest in something with a higher potential return. By investing your excess cash, you can potentially earn higher returns and grow your wealth over time. However, it's important to be mindful of your overall financial situation and make sure you have enough cash on hand to cover any unexpected expenses or emergencies. It's generally a good idea to keep a cash reserve equivalent to at least a few months' worth of living expenses in case of unforeseen circumstances. When deciding how to invest your excess cash, it's important to carefully consider your goals, risk tolerance, and the potential risks and rewards of different investment options. It may be helpful to seek out the advice of a financial advisor or professional to help you make informed decisions. Tip number 17, keep your costs low. One way to increase your returns is to minimize your investing costs. This can include things like trading fees, fund expense ratios, and other charges. By keeping your costs low, you'll be able to keep more of your returns. Tip number 18, don't be afraid to take calculated risks. While it's important to be mindful of risk, it's also important to be willing to take calculated risks when the potential reward is worth it. Just be sure to do your research and only invest in things you understand. Tip number 19, keep an eye on the economy. The overall state of the economy can have a significant impact on your investments, so it's important to stay informed about macroeconomic trends and developments. This can help you make better investment decisions and potentially spot opportunities before they become widely known. Tip number 20, have a plan and stick to it. Finally, it's important to have a well-thought-out investment plan and stick to it. This can help you stay focused and avoid making impulsive decisions based on short-term market movements. We hope these 20 tips on how to make money investing have been helpful. Remember, investing is a long-term process and it's important to be patient and disciplined. By following these tips and seeking out professional advice when needed, you'll be well on your way to building a successful investment portfolio. Bonus fact: One interesting fact about investing is that research has shown that actively managed mutual funds, on average, underperform passively managed index funds. This is because index funds simply track a particular market index and don't try to beat the market, while actively managed funds try to outperform the market but often fail to do so due to high fees and other costs.